Welcome to our next panel. The bell isn't going to ring itself. I didn't make up that title, but I do like it. What we're going to do today is we're going to have two movers and shakers, Erik Sloane and Joe Lucosky, and we're going to focus in on how Cboe is going about changing the listings in the U.S. And Joe is a securities attorney, well-versed in every step of going public, every type of merger and acquisition, uplisting, cross-listing, et cetera. And Erik is the main man at Cboe. So, ladies and gentlemen, the bell isn't going to ring itself.
Thank you, Shelley. Thank you for that kind introduction. I just want to thank you and Lulu and Bobby and everybody else at Planet MicroCap for all of your hospitality, not just this year, but throughout the years. You guys run a first-class event, and we are very grateful and honored to be a part of it. So good afternoon, everybody. My name is Joseph Lucosky, and I am the managing partner of Lucosky Brookman. We are a boutique corporate finance, mergers and acquisitions, securities, capital markets law firm based in New York and New Jersey. And today we have the honor of speaking with Mr. Erik Sloane from Cboe Global Markets, and we're going to get to more of that in a second. I just want to tell everyone we're very excited to be here because this is something that we are very passionate about and very focused on. We have a lot of data and discussion to talk about regarding the listings process. Before we jump into some of the data we're going to share with you today and talk a little bit about the exchanges and how Cboe is trying to change that process, I want to just set the stage. I think it's really important for you to understand why we do this. So I want to take everybody back quickly to April 2020, the start of the global pandemic, when things were very shaky, markets were very unpredictable. Lucosky Brookman, our firm, was involved in one of the first uplists that got completed at the height or the beginning of the uneasiness in the global pandemic. And we're working on a deal, and the bankers at the time had come to our client, come to us, come to management, said, hey, listen, we have to do a huge reverse split, a huge share consolidation, and we have to bring the shares from 50 cents up to $12, and then we're probably going to price it back down to $5, and it's hugely dilutive and hugely crazy, and you can imagine, how excited management was about that. We had resisted this process, resisted the bankers, resisted the law firms on the other side, which were some of the largest in the world. And we had this idea, this light bulb go off that said, you know what? This process isn't consistent with the data. We know it doesn't feel right. We know it doesn't look right. We know it's just plain wrong. So we stayed up all night for 2 or 3 nights. We got as many deals as we could. We figured out that, this sort of deep consolidation and split is not appropriate. We presented our data, and eventually it won the day. The deal got done. The reverse split wasn't that hard or deep, and the deal went off, and everyone was happy, during the pandemic. And that is how the data desk of Lucosky Brookman, the data-driven approach of our law firm, using data, using metrics, using numbers to give value back to our clients and to the broader ecosystem, and most importantly, on transactions. So we don't talk about our feelings. We don't talk about our individual experiences. We talk about what the market is doing, predicting trends into the future, and looking backward so we don't repeat the mistakes of history. So that's the part of the data desk that's important and why we put out these numbers. So with that, we're going to talk about a lot of data. Before we do that, I'd like to introduce Mr. Erik Sloane, who I said is the global head of corporate listings for Cboe. And Erik, maybe you could just tell the group here a little bit about yourself and your individual experiences and how you sort of came to Cboe before we get into Cboe, the exchange itself.
Yeah, certainly. And Joe, thanks very much for the introduction. Pleasure to be here with you, of course. My name's Erik. As Joe introduced, our global head of company listings for Cboe Global Markets. Prior to this, I've spent 20 years building stock exchanges north of the border in Canada with a number of large investment banks, buy-side institutions, and sell-side dealers. And that has stemmed from product management, consulting businesses, ultimately running operations with a previous market we built. and over the last 10, standing up another business that ultimately got acquired by Cboe Global Markets in 2022. So I've seen a number of different sides of this industry, both from inside our house, also selling our trading and data businesses, which drive a lot of interesting analytics and investor decisions on the street, now focused squarely on primary markets and bringing those worlds together to create successful listings for Cboe around the world.
And much like us, very hyper-focused in the emerging growth arena.
You got it.
For many, many years. So, Erik, tell us, because we're going to talk a lot today about the major exchanges here in the U.S., the New York Stock Exchange, NASDAQ, and of course, Cboe. But before we can talk about the comparisons and the differences and the positives and negatives, tell us a little bit about Cboe and what it is, how you guys got this idea of now bringing the third major exchange to the U.S. capital markets and listing corporate issuers.
This is a good story that started 50 years ago in a very different spot. And since I've got an attentive audience, I always like to get a quick show of hands if I can. You've perhaps heard of Cboe before. If I can get a quick show of hands who've heard of us before we got in the room today. So we've got a couple. Excellent. That's more than I thought. Very good. Thank you. Who's actually heard of Cboe? Okay. That's good. Good showing. So, in fact, they're the same thing. Good news. We paid a marketing firm a lot of money years ago to transition our brand from the Chicago Board Options Exchange to Cboe Global Markets, with the recognition, frankly, that we're a lot more than just options. And for us today, we're running 27 different exchanges around the world across 5 different asset classes, ranging from our DNA, options, futures, derivatives, straight through to FX markets. We run 6 different cash equities stock exchanges, all glued together over the last decade to create now a business that is the trusted market operator across the world. And that is where I came into the Cboe Global Markets journey, where for our purposes, we're now chatting about cash equities, stock exchanges on 5 different countries. You can see them up in front of you. But the US, really where we're spending a lot of our time now with the team who's thankfully sitting front and center. And I'm sure we'll be pleased to meet with all of you through the course of the day. This is where we see the land of opportunity, then leveraging our stock exchanges in Canada, Australia, the UK, and as a result of Brexit, now with headquarters also in Amsterdam. So we're really running every interesting time zone in developed markets for companies. And I think for illustrative purposes in the US, well kept on our exchange business. We're the 3rd largest market by volume traded on a daily basis here in the US. And to give you some perspective on that, we're really talking about volume traded in everybody else's listings. We compete ferociously for that business across a global team to attract some of the largest institutions, asset managers, sell-side trading firms to all meet on our markets, driven by market structure that really caters to investors. So that's priority number 1 for us. We sell the data, right? That's a big part of our DNA, our organization. And we put that in Bloomberg terminals, Reuters, FactSet, in every finance website and newspaper we can find. Data transparency creates good decisions. That's something for us that is tantamount to the whole experience really working with our business. And then thirdly, the listings platform. And this is where things kind of get exciting for us. While we're new to focusing on the corporate listings business, we are definitely not new to listings. Today, we represent over 2,000 tickers around the world. We are the 2nd largest ETF listing exchange in the US today. And if any of you participated in the crypto Bitcoin fund launches a few months ago, Cboe's actually home to 2/3 of those listed on our exchange in Chicago now. So what we are new to is focusing on the corporate business. That's really where the team and I are spending a lot of effort now, putting our brand on the map as a trusted partner for you, aspiring IPO candidates, CEOs, founders, management teams, the working group, lawyers, bankers, IR firms, and bringing that to our SEC-recognized Tier 1 market based in Chicago.
Next time, I'm not going to ask that as an open-ended question.
You left me open. I had to.
Well, look, that's great, Erik, and thank you, because I think it's important to know, just how Cboe is competing and where you're going in the marketplace. But let's jump right in, because we got a lot of data to share, and I know that's what everyone is here for. So before we can talk about the comparisons of NASDAQ and the New York Stock Exchange, I want to just set the foundational requirements, because everyone knows if you're going to list, whether that's an uplist, a cross-list from a foreign jurisdiction or a microcap IPO, you have to meet a lot of qualitative and quantitative requirements. The four most important in our view, we call the core four. Generally, if you can meet these four criteria, you can, the rest will fall in place. But these are the four criteria that give lawyers, bankers, working groups, exchanges the most fits. And I'm going to run through these very quickly because I want to get to the differences and the and some of the new interpretations. So shareholders' equity, I think, is pretty simple. Everyone knows you got to have about $4 or $5 million, depending on the exchange. Share price is either $3 or $4, depending if you're on the New York Stock Exchange or NASDAQ or Cboe. Number of shareholders, you need to have certain round lot shareholders, and then a public float of 15 million. Those are the core four requirements. If you're a company looking to list, uplist, IPO, cross-list, these are the core four requirements you need to have. And Erik, when you guys got approved last year in June 2023 to be the third major exchange, how did you guys come up with these? Because, you know, on their face, they look very similar to NASDAQ. And I know we're going to talk about some of the differences, under the surface, they're quite different. But just tell us about your thinking about, you know, you had a blank space. How did you come up with these?
So the U.S. business took a bit of inspiration from a lot of other spots in our ecosystem. But if you look at, you know, the pathways companies are taking to get public, you need a sleeve to help each company navigate their pathway, whether they're pre-revenue, they're in their growth stage, maybe they have a lot of debt, but they have revenues in their business. Having optionality for companies to get to public markets is actually a very critical part of it. Think about a biopharma company. No revenue yet, working on ideas, need to find a pathway to raise capital from investors to fund that research. There's got to be a way. So the equity requirement, the one that's on display in front of you here, gives pre-revenue, really exciting businesses ultimately a pathway to get public. Key for us is we didn't want to take an opinion on industry or sector. So we boil this down to 4 different pathways, different types of companies can take to get to us. And then we start looking at geography, economy, country, scale in business. And our Canadian business, lower requirements versus the US. The US, we've got peers to look at. And here we wanted to take a look, see what would be competitive, what would be helpful. And frankly, we also don't want to cause confusion for the working group that are already working on getting deals out. So portability, ease of use, predictability as a marketplace are all things that we wanted to gear off of when creating our initial listings.
And I would add user-friendliness.
That's a good one. That's a very
User-friendliness. From someone who works in the trenches daily with numerous company, investment banks, investors, buy-side, sell-side, user-friendliness is a very, very important. Doesn't mean we're always right. Doesn't mean we always agree. It just means that the exchange needs to stay user-friendly.
Agreed.
So let's flip, because let's talk about the deal-making process and how these core 4 requirements are interpreted, because these 5 topics on this slide under the deal-making process are the 5 hottest topics in the microcap arena today. You should take a picture of this slide. It's going to be available on the website. It's available on our website. But these 5 topics are the most important criteria to list a company right now in the United States. Before we get into those, I want to talk about just a little bit of data, because we've been saying that word a lot. And I do want to just give everyone a quick overview, and maybe, Erik, get your thoughts on the IPO world right now. So if you look at this data, this is culled from numerous sources, from the exchanges to third-party sources. You can't just Google microcap data. That's what makes the Lucosky Brookman data desk so special, because it's curated. There's a long lead time process. It takes effort to actually figure out these deals, $300 million market cap and below, putting them together. If you look at this slide, you'll see that in 2023, while the number of IPOs was dramatically up, almost 23%. And by the way, it didn't feel that way. If I went around the country speaking to people and asked, hey, how does the IPO market feel? Everybody would say, not so good. Certainly wouldn't say it's up 23%. What we're feeling in the market, though, is if you look at the average offering price and the average size price, or median offering size, that's way down from the sort of heyday of 2021 and the remnants of 2022. The deal sizes have really been cut in half. And we've been going around the country saying, if you want to get a listing done, the sweet spot for us is somewhere around 6 to 8 million based on our data, our analytics, and what the bankers and investors can tolerate in a market. And that's pretty much a 50% reduction. And we've been saying less is more in this market. One other thing I want to point out, that the resurgence of selling stockholders has come back. You know, back in 2020, 2021, even prior, selling stockholders were really not invited into deals because, as you know, bankers and new investors, nobody wants to deal with selling stockholders in the deal. They want to kind of clear the way for the new IPO investors. But because of some regulatory crackdowns and just the general market, selling shareholders have been a really, really important part of deals now to get to that magic number of a $15 million public float. But Erik, I know we've talked about these statistics ad nauseum. I mean, do you have a reaction to the, you know, the market in general of the IPO world?
It's been an interesting one, and I've spent the last 2 weeks staring at my own data. So yours looks consistent with mine, which is good. Second to that, you know, large deals and deals that are going up in price. You know, out of the last year, we're probably talking about 10, maybe 11% of all of the IPOs have a stock price that's now up from their IPO. The balance are down, and the down ranges from 1 or 2% to 90% versus their IPO price. And as we also know, every deal is different. Every cap table is different. Every shareholder group is different. So it's hard to break down every single transaction into a reason or a driver. But at the end of it, you have results in data that lead to an outcome. So consistent with what we're seeing.
Well, let's just go back for a second. Let's talk about lockups, leakouts, and the selling shareholders, because this is a very important point. When you're trying to list on an exchange, you need to get to $15 million of public float. And that is why selling shareholders have been a crucial part of the process recently, because they are making up that stopgap. If a deal can only raise $6 to $8 million, because that's what the market will bear, that other money has to come, that $15 million has to come from legacy shareholders. And sometimes that's through registration, sometimes that's just through a large enough shareholder base that is what we'll call unrestricted. But if you look at this data throughout 2021, 2023, you will see, again, just an overview that the IPO market, while up in number of deals, down in the median size. But if you look at that selling shareholder table, that's really the most important piece here, because that is up dramatically. And there is this disconnect in the market that we see all the time. There's this feeling that the investment bankers and new investors don't want to play nicely with the selling shareholders, because usually selling shareholders are in at a lower valuation. And the selling shareholders obviously are needed to get to that public float of $15 million. So obviously everybody has now warmed up to the fact that selling shareholders are necessary. But when we talk about leak-ups and lockouts, you know, NASDAQ has this rule that they don't count for public float any legacy shareholders that are locked up or leaked out, even if they have the ability to trade in a leak out. And that has been a really, really tough talking point as we're doing these deals. And when you were putting the requirements together for Cboe, you guys took a little bit of different of approach. Tell us about your approach to lockups and leakouts, which is similar to the New York Stock Exchange.
Well, this is where understanding the anatomy of a deal actually matters, right? In micro and small cap businesses, you're trying to bring together a lead order, an anchor order, somebody who actually can deliver a selling group or a shareholder group into a business. You don't build it off of a broad-based IPO distributed to all retail investors unless you've got something really interesting as a brand and a message. And those opportunities aren't as common, frankly, as we'd like. So being able to put in some kind of implementation where we allow for the company to ultimately protect some of their shares, put them in a leak out or a lockup schedule, those early shareholders that maybe got in at a great price, that may be looking to sell. Well, if the company wishes to lock up to $5 million worth of those securities, but are still being held in public investors' hands, so they count towards your public float, we're okay with that. And that's really comprehension, I think, on our end in understanding that at the end of it, it's good for the company if they can get public. They have a plan, mission to raise capital. That's happening. And you check the second box, which is we're now protecting or restricting some of those shares ultimately from trading day one, gives the company time to get their feet under them. And then once the lockout starts coming out, hopefully management starts delivering on their mission in market, which will hopefully protect the price.
Right, just a more user-friendly approach to getting a deal completed. I'm getting a signal here, so I want to skip around a little bit. We don't have time to go through all of these, but I do want to just cover one more point before we get to the Q&A, which is the simultaneous reverse stock splits. We talked a little bit about this story at the beginning of this panel about reverse stock splits and trading, and I just want everyone to see here that the uplisting market, which is listing from an alternative platform, whether that's domestic or foreign, has gone into a downward spiral since 2022, shockingly downward. In 2021, there were 66 deals completed in uplisting world. In 2022, the first 3 quarters, there were 49. From that fourth quarter of 2022 through present day today, there was only 25 uplisting transactions, and 10 of which raised capital. That is a dramatic departure from where we used to be in this market. And we believe, aside from market downward, the market being challenged, the NASDAQ's rule of not allowing a simultaneous reverse split and listing has contributed to that downward market. Now, there's a lot of factors. I don't want to just blame NASDAQ. They have a very tough job. They're the leader in our space. They list the most companies, but it has contributed. They've now implemented a 5 or 10-day trading window. Cboe is doing it a little bit differently, which we think will give the uplisting market a little bit of breath of fresh air. Maybe you can just talk for about 20 seconds before we get to Q&A about that process.
Give me 30 because I have a second perspective I want to put on top of that as well. But yes, like we want a conversation when a company is approaching consolidation. And for us, we're looking at, are you raising money when you're going into it? Is it significant related to the market cap of the business? How are you creating support at a new price point after the consolidation is done? And by bringing in new shareholders, you get a bit of a barrier on what will become some pressure from shareholders who see that message and are trying to decipher, why are you doing a consolidation? And that's a signal, you're sending it to the market, this is a different message. So we're okay with that. We want a conversation, that was really the point. The other thing I wanted to bring forward, Joe, is, been traveling the world over the last 3 weeks. I was in London, Amsterdam, Copenhagen. Canada obviously is home base for me, but a lot of the companies we're chatting with all want to be here. They're all focused on preservation of capital at the moment. How can I make sure that I can run my business responsibly? But the US is the holy grail of capital markets for a number of aspiring businesses, so don't be surprised. You start seeing this tick up as we get macro certainty elsewhere.
And as we get to a quick Q&A, I just want to mention that anchor investors is a very hot topic in our world as well. It used to be that if a microcap company secured an anchor investor, a Gabelli or a Wellington or a T. Rowe Price, we were all high-fiving. This was the greatest thing in the world. It has become very challenged now with anchor investors and concentration and distribution analysis, especially with respect to clearing the deal, mainly related to NASDAQ. And I know Cboe and the New York Stock Exchange take a very different approach, maybe more user-friendly, maybe just because NASDAQ has so many deals and is under the hot seat with the regulators all the time, they have to take a little different approach. But those are 2 other hot topics that everyone should just be aware of, this anchor investor concept, which we don't have time to really get to, and this concentration and distribution analysis that is very, very important. By the way, next year we're going to need another 30 minutes.
Could you talk for the Cboe, the aftermarket performance of your new listings? How have they done? And then what does Cboe do to help your issuers achieve good performance? And I know the other exchanges have different things that they do, but what do you do to help that, and what's your track record been?
Certainly. I'll stand for Cboe, though. Cboe, we're trying to put away for another day. So when you look at the current performance, right, we've got 3 corporates listed today, 1 our own stock. Cboe is the ticker, listed on our own exchange. We're a $20 billion company. That's been there for a while. Stable institutional base. We have 2 new IPOs that have been completed. One was an uplist, one was a straight out IPO onto our markets. And ultimately, they're going through some shareholder turnover at the moment. That shouldn't be a surprise, and you take that into context of the discussion I led with at the beginning. IPOs right now, it's a hard market. You've got a group of shareholders who may want out, who have been there for a while, see some news, want to move on. And the key for us, and this is my economics training coming back in, you got to do what you're going to do as a CEO. So that coaching into the management team, keep delivering on results, and they've got to be real, tangible in this market. We can't be working off of promises. And second to that, it's investor relations. How do you find new buyers into the business, and who can you partner with that can help you find quality new buyers into the stock potentially at a lower price than where you might have gone out at. So it's an opportunity for the company to start marketing again. Now, we're talking about a data point of 3. We've got a lot more to go. The team's been busy, and I think you'll see some news from us in short order, and hopefully we'll be able to better benchmark the next time we have the conversation versus our peers. But for now, that's the data point we have.
The good news is, Eric, and I talked to a lot of investment bankers and investors and shareholders. There is hope for the Cboe to come and help build the competition, penetrate this market, but at least we know that the plumbing works. We know that companies can list. We know that they may not be doing well given the market conditions, but they're doing as well as the competitors because the entire market is down. But can you just speak to sort of the plumbing in the sense? Because I get this comment a lot. Well, we don't know if they can actually do a listing. Well, you've done 3.
3, and then married to the comment earlier, we are the 2nd largest ETF exchange in the U.S. So if you touch a retail platform, the instruction, and Bill leaves this message behind in every meeting, and I love it because it's simple. Can you type in a ticker, and can you hit the buy button? And if the answer is yes, it's the exact same. And by the way, you've probably been trading on our exchange for a whole host of ETFs, hopefully our own stock over the course of time, but that shouldn't be a surprise. And it's Robinhood through to a Bloomberg terminal, largest pension plans, asset managers, index eligibility where it needs to be. Mm-hmm. So I can repeat your question. Do you think it has something to do with the cost of listing in the U.S. that's driving the uplisting behavior?
Correct, yes.
Specific to Cboe, or generally speaking for all markets? So the one, and I've seen a few different studies from actually a few large audit firms, both for North America, Canada, and the U.S. specifically. The exchange listing fees are the very small spear that gets attached to a U.S. or a Canadian listing. There's a lot of other fees in the group. Ours are not really significant in the grander scheme of a transaction, but the lifetime of a listing, being a public company, is where the cost consideration shows up. In the U.S., that's D&O insurance, that's audits, audit compliance. We heard in the last panel, timeliness of everything getting done, never mind the disclosure and obligations that go into being a public company. So you got to take a real decision. Do I want to be there?
Let me just add to that. You hit a hot button issue for me. I speak a lot about cost of transactions. It's something that drives me nuts. And Eric is right. It's not the cost of the exchange. It's not even the cost of the auditors a lot of times, although, the better the auditor is, the bigger the name, the bigger the price tag. I see, and unfortunately, I'll say it against my own profession, the legal fees in these transactions are out of control. And it is a hot button issue for me because, look, most of the partners in our firm grew up at some of the biggest AmLaw 100 law firms in the world. We have nothing against big law firms. We're all classically trained. We're all good lawyers. We all got to get paid. But when you have a microcap company doing an uplisting or an IPO, and you have a top 50 firm in the world charging $1 million for the listing or $2 million, this applies to the SPAC world as well. That is where we draw the line. It is out of control. The proportionate amount of fees has to be in line with the type of transaction you are trying to do. And I'm not saying we are cheaper or we work for free, and there's many good law firms that are our competitors. All I'm saying is, to your point, transaction fees across the board for all professionals have gotten to be out of control, and they need to come back in line for the betterment of the entire industry, the entire ecosystem, and so we can all keep doing the right deals with the right people and we don't lose our marketplace.
Yes, thank you all so much for being here.
Thank you. Thanks for having me.